Have you ever wondered how the stock market works? It's a place where you can become a part owner of a company by buying stocks. Essentially, when you purchase a stock, you're buying a small slice of a company's future. Companies issue stocks to raise funds for uses like research, market expansion, or debt payment. By investing in these stocks, you're betting on the growth potential of the company. If the company thrives, your investment benefits too. So, investing in the stock market is not only about buying and selling stocks, but also about participating in a company's journey. Now you may be wondering, how does one get started with stock market investing? To start investing, you need to understand what stock exchanges are. They're dynamic marketplaces where you trade pieces of companies known as stocks. They're crucial in global finance, offering a platform for trading shares. Notable exchanges are the New York Stock Exchange, or NYSE, and the NYSE is the largest, home to companies like IBM and Coca-Cola. Nasdaq, meanwhile, hosts tech giants like Apple and Google. The key to these exchanges? Transparency and fairness. Prices depend on supply and demand, and all transactions are logged. This helps uphold trust, making stock investing accessible for everyday people. So, you've got your stocks, but how do you make money from them? Making money from the stock market revolves around two key concepts. It's more than just purchasing and selling shares. It's about grasping how these shares generate profits. There are two primary methods: capital gains and dividends. Imagine you're buying a valuable painting, hoping its value will increase. In the stock market, this painting is the share you purchase. If the company performs well, the value of your share rises. Selling your share at a higher rate, the difference is your capital gain. But what about not selling your share? This is where dividends come into play. These are a portion of the company's profit shared with shareholders. So, whether it's through capital gains or dividends, you're earning money. Moreover, you can enjoy both at once. But remember, not all stocks provide dividends, and not all assure capital gains. Hence, it's crucial to select the right stocks. And this selection requires understanding the company, the market, and numerous other factors. It sounds easy, right? But how do you pick the right stocks? Choosing the right stocks is where your investing journey truly begins. It's not just about picking random names, but a comprehensive assessment of the company and market conditions. Start with the company's performance. Examine its earnings reports, profit margins, and revenue as indicators of health. A strong performance might suggest a good investment, however, growth speed can often blur your judgment. Past performance does guarantee future results. Consider industry trends. Are they on an upward trajectory or fading away? A growing industry can uplift even ordinary companies, while a declining one can pull down strong ones. Acknowledge market conditions. Are prices and optimism rising or falling? This can be challenging, but it's essential. Lastly, equip yourself with as much information as possible. Consult news, podcasts, financial analysts to make a sound decision. Selecting the right stocks is an art, a mix of facts, instinct, and sometimes luck. It's a process of continuous learning and observation, but remember, with higher potential returns comes higher risk. Investing in the stock market is not without its risks. You've probably heard this phrase, but what does it mean? It implies that the value of your investments can increase, but it can also decrease. This price fluctuation is the inherent risk of investing in stocks. It's a thrilling ride with highs and lows. Consider Bob, who invested all his money in one stock. When the stock soared, Bob was ecstatic. But when the company hit a rough patch, the stock crashed, and so did Bob's investment. This highlights the importance of diversification, which is spreading your investments across various assets to minimize risk. So you're not putting all your eggs in one basket. Instead, if one basket falls, others may still be standing. But diversification isn't enough. Risk management is crucial too. You may need to set a budget for investing, decide when to buy or sell, and review your portfolio regularly. The stock market isn't a get-rich-quick scheme. It requires patience and discipline. Alice, with her diversified portfolio and disciplined approach, saw her overall portfolio grow over time, despite some underperforming stocks. Remember, investing is not just about seeking rewards, it's about understanding and managing the risks too. Let's take a moment to recap what learned today. We began by deciphering the stock market, seeing it not as a complex entity, but as a marketplace for trading company shares. It gives us a chance to own a piece of a company. We then delved into stock exchanges, the sites of these transactions. Exchanges like the New York Stock Exchange or the Nasdaq serve as economic pillars, facilitating capital generation and informed decisions. We dived into the profit equation, the concept that unveils earnings in the stock market. By buying low and selling high, we profit. However, patience often prevails over perfect timing. We then discovered stock picking, understanding it's about thorough research, and not simply following others. Lastly, we touched upon risk and reward. Investing carries risk, but potential risk brings potential reward. About finding balance and diversifying your portfolio. Remember, investing is a journey. It's not a get-rich-quick scheme, it's a process of learning, making informed and consistently investing over time. Stay informed, stay patient, and may your investments always yield fruitful returns.